We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Christian, Managing Partner of CPM Group. Thanks for joining me today, Jeff.
It's good to be back with you, Tom.
Excellent to have you as always, Jeff. And of course, you guys just released your massive 2022 Gold Yearbook. So why don't we start by kind of getting some of the perspective on the actual gold price, where we are right now, and taking that kind of into a longer term view rather than an emotional short-term view.
Okay. Well, yeah, the gold price right now, it actually shot up to $1,952 today, Friday, the 8th, as we're talking. But it's basically been trading between, say, 1915 and 1950 for the last couple of weeks. We had seen the price rise to a record in August of 2020. It came down and it was consolidating at record high levels around 1780 to 1860 last year into this year. And, people kept saying, gold bugs kept saying, why is the gold price so low? And the reality is that the annual average price last year was a record. It surpassed the record annual average price in 2020, because when the price rose in 2020, it only rose starting in July. Well, it started rising a little bit before that, but it really broke higher over 1600 in July. So it was really the second half of the year saw high prices and first half saw lower prices. So we had this consolidation period. Russia invaded Ukraine. The price shot up on one day, like I think it was March 7th or so, to about $2,058 on a settlement price, $2,078 on an intraday price. It came back down quickly, like the next day. And what we are seeing is the consolidation. Right now, the gold price is consolidating at a record high level. And you've got a war premium in there. You have an inflation premium in there. So that is helping to keep the price up. Longer term, our expectation is that at some point the war moves to either toward a settlement or a stalemate, or there's a clear path toward a settlement. And quite frankly, things could get a lot worse before they get better. But we think that by the second half of this year, probably not in the second quarter, but in the second half of this year, you might see a dissipation of that war premium, not a disappearance of it. It's not going away, because probably you're going to have a stalemate. You're going to have Russian troops occupying disputed territories in eastern Ukraine. You're going to have a tinderbox situation there. So you'll see a dissipation of the war premium. And also statistically, we do expect lower inflation figures in the second half of this year. Really starting around June, you'll start seeing them with the release of the May CPI data. And so we expect some dissipation of the inflation premium. Mm-hmm. Interest rates, meanwhile, will be rising and will probably be 1% or 1.5% higher in the second half of this year than they are right now. And that'll be a little bit of a headwind for the economy, for the stock market, and for gold and silver. So we think that the gold price could dissipate, come back down into the 1780, 1880 range. We don't see spikes down to 1680 the way we saw it 3 times last year. We think the price stays high relative to where it was last year, but you could see some reduction in concerns about the economy and the world and things like that, which could lead to that. Longer term, we're still very bullish on gold because there are a lot of problems and there are new problems that are popping up, and there are problems that were there that people weren't aware of that are all of a sudden they're aware of. So, we still think there are a lot of issues that the world and the United States and various governments are facing, and we think that those things are going to be problematic over the long run, and that's going to be reflected in higher gold prices.
There's a lot to get to there. I want to get to the kind of the interest rate and the CPI picture for sure. But when we think about gold investors thinking that the gold price is so low, do you think that that's due to the idea that sometimes we're maybe promised, or the gold price rise can be sensationalized a little bit and sometimes needs to kind of come back to earth, or expectations need to be managed a little bit better?
Well, yeah, I mean, there are several problems. First off, there are a lot of people who just believe that the price of gold should be much higher. They have no fundamental or economic or statistical basis for that. They just feel that it should. There are a lot of people who believe that the world's going to collapse, the financial system is going to collapse, and gold price is going to be higher. Then there are a lot of people who overhype gold, and you hear all these weird things. And then you have a lot of strange beliefs, and they're really widely held. I mean, I know multi-billionaires who have strong beliefs, and when you talk to them and you show them charts and tables, that say your belief is incorrect, they just ignore it. Mm-hmm. So, gold should be higher because the dollar is lower. Well, the dollar is actually not lower. Gold should be higher because if you compare gold prices to, say, the prices of automobiles or wheat or other stuff, these things have risen in price and gold hasn't risen as much. Mm-hmm. And, let's look at a historical relationship between wheat prices and gold prices. They've ranged from 1 to 100, the ratio. Let's look at gold versus oil. It's ranged from 10 to 100. Let's look at the gold silver ratio. It's ranged from 16 to 1 to 120 to 1. But then you have these promoters who come up with all kinds of things and say, well, these things are all rising and therefore gold prices should be higher. And you look at it and say, well, no, because the fundamentals of those things say, hey, this price is higher. The fundamentals of gold say, no, prices fairly valued are actually relatively high priced right now. And the relationship doesn't hold up over time. Mm-hmm. So for you to say that, since housing prices have risen from X to Y, gold should have risen from X to Y, there's no reason to believe. And if you stop and think about it, housing is a lot more of, in Abe Maslow's hierarchy of needs, housing's down there in the base, and having gold in your portfolio is kind of high up in it.
Yeah, I guess it's relative, dependent on what your needs are at the time. And when we think about these relationships or these correlations to other figures, let's say, what is the relationship between money supply and gold? We've seen an enormous amount of dollars brought into existence over the past 2 years, but that doesn't necessarily translate into higher gold prices, right?
Right. Well, it's interesting. And when I was talking to you at the outset about gold prices and the economic environment, I was leaving out the transmission between them. So what if X, Y, and Z, inflation, interest rates, and they're doing this? How does that affect the gold price? And it affects it through the investor demand levels, right? So if you look at money supply versus gold, let's look at the intermediate step, money supply versus inflation. And again, the correlation isn't there. And it definitely changed radically in 1982. Paul Volcker took over the Fed in 1979. And to Jimmy Carter's credit, he hired Paul Volcker to beat inflation. And Paul said, that's going to throw the country into a deep recession, and it's going to cost you the election, which you'll probably lose anyway because you got those hostages in Iran. And the Reagan campaign is actually saying to the Iranian government, keep those Americans as hostages until after the election, and we'll be nicer to you, which is trading with the enemy, and it's against the law. And Bill Barr, as a junior attorney at the Department of Justice, pardoned everybody in the Reagan campaign that had been convicted, like 22 people, convicted of trading with the enemy during the Iran-Contra scandal. So Volcker changed the way central banks work. And he said, when you get into a recession or other financial crisis, you pump as much money in as possible to get out of there. And then you sell bonds to suck up the excess money supply, reduce the liquidity, and sterilize the inflationary consequences. And that has been the case in 1982, 87, 91, 97, 2001, 2008, and we'll see if it works this time too. So you look at the correlation between money supply and inflation, And it's not a good correlation statistically. Then you say, okay, well, what about money supply versus gold? It's not a good correlation statistically. Mm-hmm. So the idea that you have all this money out there is a risk that you could see higher inflation and higher gold prices. If you want to call higher gold prices a risk, I wouldn't. It provides the potentiality of higher gold prices, but historically over the last 40 years, it hasn't resulted in higher gold prices, mm-hmm. except on a short-term basis when investors see all of the money supply pouring in and they say, this has got to be hyperinflationary. And then 6 months later, when it's not hyperinflationary, they sell their gold and the price comes back down. Mm-hmm. So that's the correlation between them, And if you look at growth rates in money supply, it shot way up in 2020. And now it's back down almost to the pre-pandemic levels of money supply growth for M1. And we look at MZM, which is broad money. Mm-hmm. It's funny because a lot of people have been looking at M2, which has certain advantages over M1. But again, they're looking at it because their M1 relationship with gold prices don't hold up to their theory. It doesn't support their theory. So M1 must be bad. If the data doesn't fit if the data doesn't support my theory, the data must be skewed. Mm-hmm. Yeah.
So Jeff, when we think about you're talking about investor demand and really we're thinking about expectations, right? So when these expectations are driving gold demand, who do you think is really the ones that affect the gold price the most? Is it these institutional buyers? Is it the individual people that are buying maybe 5 to 10 ounces at a time? Is it central banks? Who are the ones that are really driving that gold price when we see it up sharply? Do you have a good way of understanding who those people are?
It's a very complex situation because if you talk about central banks, you're talking about 12 to 30 participants. Mm-hmm. So each of those participants has a more significant role in the trend within central bank buying and selling. If you talk about large investors who are invested, you're probably talking about a couple hundred, still a very small portion of the population. And then when you talk about retail investors, you're talking about tens of millions of people worldwide. Mm-hmm. Now, if you talk about the effect on price, a purchase or a sale by one of those larger institutional investors or family offices or central banks can have a more immediate and visible effect on the short-term price over a day, over a week, over a month. I can tell you, for example, in the late 1992, we said to our clients, the gold price was kind of dead in the water. And we said, look, we've been saying that we're looking for a change before we issue a buy recommendation. We're planning to issue a buy recommendation. All of this stuff is changing, but there's one central bank that has sold gold forward for delivery into January and February. And we're just telling you that that's going to be a lid on the price while that metal is delivered between August, September of 1992 and January of 1993. But if everything else holds together, once those forwards are delivered, we expect the gold price to rise. So we issued that buy recommendation, and we actually issued a public buy recommendation in February of 1993 based on that. So you can see that. But if you're talking about the longer term price, it's the retail investors because they tend to buy more volume. They tend to buy and hold much more than those other guys. Well, that's not necessarily true. A lot of it, we have institutional clients, family offices, and private individual investors, high net worth individuals who have enormous amounts of gold and they've held them for decades, and palladium too, and platinum and silver. So they are long-term investors, and central banks have no time horizon on their gold. They buy gold and they put it in the vault and that's it. They don't say, well, what's the potential return over the next 3 to 5 years, the way an institutional investor does. But those retail investors seem to buy much more volume and they tend to be buy and hold. So they tend to have a stronger effect on the long-term price than the large ticket items. The large ticket items can affect the short-term price most notably, but because of the sheer volume of the retail, both in terms of number of participants and the volume of gold they're buying. So the depth and the breadth of the retail market makes it much more dynamic and important to the long-term price of gold.
So when we're thinking about as well the kind of these correlations to gold price, how does the relationship between the Fed funds rate and the gold price hold up over time?
It's funny. I my wife took me out last night for a belated birthday present, and we were at a restaurant, and the correlation between changes in the Fed funds rate and changes in gold prices is 0.4%. And being who I am, I said, Fermilab in Chicago has just released a paper. They have found that the weight of the W boson subatomic particle is actually 0.1% off from what the number that everybody has used in calculations. And that 0.1% changes everything in terms of quantum physics. In finance, 0.4% is meaningless, and in human activities. And one of the mistakes that a lot of people make is they take scientific methodologies, things that are physical science methodologies and quantums, theories and equations, and they try to apply them to finance and to other human social interactions. And they never work. But, it's like, hey, this is something concrete. Maybe it works. But it's 0.4%. So the increase in the Fed funds rate over 1968 to the present, the period of free gold prices, the relationship's 0.4%. Now, you can look at periods of time like the 1970s when the Fed funds rate was 6% and it went to 14%. And you say, wow, that had a dynamic effect on the price of gold. But you can look at other periods like right now when the Fed funds rate is going from 25 basis points to maybe 3% by the end of the year. That's probably not going to move the needle in the economy, the stock market, or in gold.
Yeah. So again, we really have to kind of separate these ideas and analyze them for their fundamentals. Go ahead.
In our gold yearbook, we have a table of correlations. Gold relative to inflation, the trade weighted dollar, S&P, Dow Jones, T-bills, T-bonds, and silver. And we break it down. So here's the top line is 1970 to the present, but then we have different periods where those correlations are more or less important. So yeah, you have to look at it. You have to look at it. You have to look at why interest rates are rising, and you have to look at how the market perceives those interest rates. If interest rates are rising because inflation is rising, do the markets say, oh, interest rates are rising and the Fed will successfully sterilize inflation, in which case it's bearish for gold? Or do they say, oh, interest rates are rising because the Fed is worried about inflation, but they're too late and the prices are going to skyrocket and we're going to have hyperinflation, which is bullish for gold. The gold promoters on the internet will tell you the latter because they want you to buy gold from them at a high premium. But economists and other academics will look at it and say, probably, the odds-on favorites to win this battle is the Fed. And so rising interest rates are probably negative for gold. But in this case, it's a very small negative because they're so low to begin with, and they're probably not going to rise so high as to turn off investor interest for gold.
So, you brought up the idea of the Fed getting to basically 3% interest rates, let's say by the end of this raising cycle. So do you think that is enough to actually, in some ways crush the inflation that we're seeing and also possibly the economy along with it?
I think it's enough to reduce inflation, and I don't think it's enough to crush the economy. So our expectation is that the Fed will succeed in engineering what economists call a soft landing. We think that you'll see inflation come down for a variety of reasons, including the rise in interest rates, but the interest rates won't rise so far as to throw us into a recession. And they won't rise so far as to make stocks uncompetitive, and they won't rise so far as to make gold unattractive to investors. I mean, 3% inflation. Okay, so what? 3% interest rate. What's going to be your inflation rate? If we say that we think the inflation rate could be 3%, that means you're going to 0% real inflation adjusted rate. That's not the kind of return most investors want. But the Fed says that inflation is going to 5%, so you'll have a negative 2% real interest rate. That's definitely not enough to cause people to say, why would I own gold when I can lose 2% a year by holding treasuries? So we don't think that the interest rates will rise so high as to hurt the economy or to hurt gold.
And of course, there's so many other, let's say, unforeseen circumstances that could change that between now and then. Like I think something that we have yet to see play out is how China kind of plays into this whole conflict, whether they're going to kind of back Russia more or they're going to move on Taiwan more. What are your feelings about something to do with China like that?
Well, I was about to say at the end of my last answer, ceteris paribus, all other things being equal. Because one of the things that you're seeing is a tremendous increase in uncertainty and an increased number of things to be worried about. I think that, it's hard to say how China is going to react. I think one of the things that you're seeing right now is that the Chinese Politburo and Chinese leadership in general is very carefully watching what Russia does and how the United States and the world react to Russia. And, China, there's certain parallels between China, Xi Jinping, and Taiwan, and, Russia, Putin, and Ukraine, but there are very large, very, very large differences between those two countries. And you have to pay attention to those differences. But I think that the Chinese leadership is saying, okay, overall, they're saying, okay, let's watch this. Okay, using military power to try to reconquest neighboring countries that you dominated at times in the past probably isn't a good idea. It impoverishes you, it destroys your economy, it destroys your stature in the world, and it's very hard to succeed. And we're watching what happens. And, it's still actually too early to say whether or not NATO and the US get involved in this thing. So I think that that's happening. But I think at the same time, there are certain people within the Chinese Politburo who are saying, Putin has spent 22 years getting rid of anybody who could replace him as president of Russia. And Xi Jinping has spent maybe 6 years getting rid of anybody who could replace him, as premier of China. So maybe we should start thinking about who comes next, plan of succession, because that's a major issue in Russia. And, I'm sure Xi Jinping is saying, no, don't worry, guys. It's like I'm the Pope. When I get to a certain age, I'll retire. But I think there are probably other people who, don't say it in public. There used to be a place outside, it's actually inside Zurich, a forest. There was a park in the forest. And if you wanted to talk with your communist counterparts, you would probably stay at the Hotel Bar-o-Lac. And there was this cog railway that went up to this forest. And you would take the cog railway up to the forest, and then you take a walk in the woods. And at a certain point in the woods, you would say, okay, it's probably okay to talk now, because the trees have ears up to a certain distance from the cog railway. So I think that there are probably a lot of conversations going on during long walks in the woods outside of Beijing.
Yeah, it makes sense. So, Jeff, I'd like to go back to kind of the inflation picture. Something that, again, I think we need good perspective on is the idea that CPI is the rate of change, right? We're comparing it to last year's numbers a lot of the time. So that is one of the reasons that we could see inflation numbers like CPI come back down later this year. And, with the perspective of the fact that price levels can stay elevated, right?
Right. Yeah, we're not projecting or predicting that price levels come down.
Mhm.
What we're saying is that the rate of change in price levels will come down or slow.
Mhm.
And part of it is that people tend to look at inflation and other things year over year. We look at it year over year, but we also look at month to month. And the month to month gives you a much better idea of what's happening now or last month,
Yeah.
And so you can see much more variability. If you look at last year, 2020 was a year of pandemic, global lockdown, and a 3% negative GDP global recession. 2021 was a year not only of economic recovery, but we saw a number of demand factors like imports of goods into the United States. They didn't rise to pre-pandemic levels. They rose to 20% over pre-pandemic levels. So you had a very strong increase in demand in 2021. And the prices were depressed in 2020 and they rose in 2021. Mm-hmm. And if you look at it, even look at the year over years, in the first quarter of last year, core inflation was 1.3, 1.2, 1.6%. The prices of energy and used cars, oil-based energy and used cars, started rising in March. April, it got bigger. April, May, June, they rose sharply. Now, it's April now. We will see March CPI figures, I guess, next week. And what we'll see is that we're measuring March to March, and March of 2021 was still low. So you're going to have a high inflation figure. April, that's May, you'll see April. By June or July, you'll be looking at May or June CPI data. The price levels were already very high. Some prices like wheat and oil are going to probably rise further, but a lot of other prices won't necessarily fall, but they'll probably not rise as fast year over year as they were in May, June, July. Actually, they came down, the price rate came down in July, May and June last year. So what you're going to see is a decline in the CPI, the consumer price index, the rate of change of prices. Mm-hmm. And that's what people key off of. Obviously, as a consumer, I look at what the price level is. And, I don't sit there and say, oh boy, this price is, 10% higher than it was a month ago. What I say is, boy, this price is high, but a lot of investor types look at the percentage increase or decrease in prices. And so you're going to see that CPI percentage change come down even as prices stay high.
Mm-hmm. Yeah, I think this nuanced discussion that we're having about how these different pieces actually affect CPI and affect the actual fundamentals of these markets is really good to have, Jeff. And I want to spend a little bit more time kind of doing that a little bit so that we get a better idea of this landscape that we're in right now. So is it possible that as a large portion of how CPI is calculated, that a rise in owner's equivalent rent adds up to a higher CPI as this calculation catches up with the dramatic rise in housing prices?
No, not well. It will. Higher purchase prices will show up in the equivalent of homeowners' rent, because a third of the housing in the United States is homes owned by people with mortgages. And those mortgages, that's where you'll see the pressure come in. I would say, I just want to back up to your something you said. BLS.gov, the Bureau of Labor Statistics.gov. You can go there. You can search for the CPI. You can find the most recent report or an older report and click on it and download it as a PDF. And you can read it. And most of the people who pontificate about CPI have never read it. And it's a very enlightening document because it explains how they calculate inflation, and it explains the different calculations for different things, including housing, including food. Most people don't realize this, the CPI and the PPI, these are surveys. They're not censuses, statistically speaking, they're surveys. And they survey several thousand people around the country. And those people say, this is what I bought this month. and this is what I paid for it. So it's actually very granular data that reflects actual purchases on a consistent basis from the same households. And you can go through it and you can see what the inflation numbers are with a tremendous, it's like a 40-page document. And most people who hold themselves forth as experts on CPI have never read it, so that's that. Now, the housing issue, again, it's like purchasing a house. Most people don't purchase a house every month. So the purchase price of a house is a capital investment, and the CPI measures what you're spending. So what you're looking at is, what is your housing cost? What is your full in cost of housing? If you're a renter, rent plus any utilities you pay. If you're a homeowner like I am, but you don't have a mortgage, it's your utilities. And since I have solar power, it's my natural gas from my stove. And if you are a homeowner with a mortgage, it's your mortgage payment and your utilities. And to say that housing acquisition prices should somehow, a capital acquisition should be somehow or other in a current account acquisition index, is to say, I never actually took economics in college. It just doesn't make sense.
Mm-hmm. Yeah, again, I think it's important to kind of drill down into those differences and to try to really get a better understanding of how all of this stuff works. Because, if we just read the headlines about it, it's not useful and can be misleading, right?
Yeah.
So
on both sides.
Absolutely. And that's the point I'm trying to make, is that it's really, it can be used, like you say, on both sides for, good or bad, or however you want to put that. So how do you see energy prices affecting the CPI numbers as well here?
Well, it's interesting because obviously energy is a very big factor in the CPI. And it's a very volatile factor, which is why a lot of people will, like, if you look at our Gold Yearbook presentation online, you'll see a chart where we break down core inflation versus headline inflation. And most people will do that. And core is inflation less food and energy. And that's because food prices and energy prices are so volatile that you take those out and you look at the core. Mm-hmm. And you say, this is what the underlying inflation rates are. And on top of that, for example, last year, on top of that, you had a very sharp increase in petroleum-based energy in the second quarter, came down a little bit in the third quarter, and then in the fourth quarter, petroleum-based energy products, because people don't buy petroleum. Consumers don't buy petroleum. They buy gasoline, they buy heating oil, they buy distillates, indirectly they buy jet fuel. So it's petroleum-based energy that you're measuring in the CPI. And it has been very volatile in the second and fourth quarters, and then again in the first quarter because of the Russian invasion of Ukraine. So it's going to continue to be a big function. Mm-hmm.
So something you brought up earlier was the wheat prices as well. And I want to get your take on, absolutely separating out the food and energy prices is, again, important to think about. But, when we see the fact that, with the conflict right now, we're seeing dramatic rises in the price of wheat and, let's say, fertilizer, because those two exports are being affected so much by the conflict. Mm-hmm. How are they going to play into this as well?
Yeah, food prices are going to be elevated. They're going to be elevated for at least a year. Wheat, obviously, is a major export of both the Ukraine and Russia. Corn is also an important export. Sunflower oil is a very large export from Russia. And so you're going to see cooking oil prices go up. And that, cooking oil and sunflower oil, it's not only used to cook stuff, but it's also used as an ingredient in a lot of prepared foods like baked goods and stuff like that. So you're going to see that. And then the potash and fertilizer costs will go up, and that will raise the costs of growing other stuff. So you're going to see that. Now, wheat, corn, sunflowers, those are all annual crops. So, and we've seen the Russian troops burning wheat fields in the Ukraine. So, people thought that they were focusing on city centers, but they also spent some time in the rural area destroying the crops. So you're going to have high food prices this year. And hopefully the war is resolved this year, and next year you start rebuilding and you start replanting and you can recuperate that and you'll see some come down. Mm-hmm. So that's that. Would you also ask about energy prices or not?
I think we already kind of covered the energy side of things.
I'll say one thing about energy prices. Mm-hmm. You saw prices rise very sharply in December of last year, from December last year into February 23rd. Mm-hmm. Oil prices probably went from like $65 to $95. And then the war started on the 24th of February, and the price went from $95 to $125 or $127. And it's now down to about $96. So that initial shock of the war and what it could do to oil prices has dissipated. Mm-hmm. But the oil price is still 30%, 35% higher than it was in November of last year. And, people are debating, well, why did the price rise from December 1st through February? Was it in anticipation of a war or was it other factors? And the answer is yes. There were a lot of other factors that were pushing oil prices up that haven't gone away and haven't been resolved and haven't been reversed. Mm-hmm. So oil prices are going to stay high. But depending on how the war is prosecuted on both sides, you could see oil prices rise sharply again, or you could see some very interesting bifurcations in the oil market.
Mm-hmm. And, just to kind of touch on what you mean by the bifurcation in the oil market, you were kind of sharing with me before we hit record something that could happen within Europe.
Well, if Europe bans oil and gas imports from Russia, then you have a situation where oil and gas prices might rise in Europe, but they might fall everywhere else because the Russians are trying to raise foreign exchange by selling their oil and natural gas wherever they can at whatever price they can. So you could see some very interesting geographic arbitrage opportunities in the oil market because of if that happens. And there are people in high places pushing for that to happen.
So, something else that we've kind of heard get a lot of attention recently is the inversion of the yield curve. So is this not necessarily causative, but is it just more correlated to a future recession?
I think, there is some causation there, but I think it's more a coincidental type of thing. That what you tend to see is that as an economic expansion cycle matures, you start seeing credit risks rise on the short end, and that tends to push short-term interest rates up. Now, that increase in shorter-term interest rates relative to longer-term rates has a negative effect on short-term growth in the economy and can contribute or does contribute to a recession, but it's more an indication of bigger issues that are tilting us toward a recession too. So a lot of times you'll look at gold and the dollar, and they'll be both moving in one direction or another. And people say, well, gold's reacting to the dollar. And say, no, gold and the dollar are both reacting to something else, often interest rates.
Yeah, kind of pointing towards these causations at different times. Right. Creates a completely different narrative, right?
Mm-hmm.
So, when we're thinking about the recession that we can see coming, you guys are projecting another recession somewhere 2024 to 2026. Are there any particular events that you see catalyzing this type of recession?
The U.S. election in 2024.
Okay.
The fact that you will be 3 or 4 or 5 years into an economic expansion, mm-hmm. the high amount of federal deficits, not only in the United States, but around the world, mm-hmm. And the consequent growth in sovereign debt around the world, very large increases in non-sovereign, corporate and consumer debt. Interest rates will have been rising probably for 3 years. We don't think that a move from 0 to 3% in 2022 is the end of the interest rate increase cycle. We think it's the beginning of it. Decreased international cooperation among countries. The resolution and the political after effects of the Russian invasion of Ukraine. I'll use the term again, I hate to use it twice in one interview, but the bifurcation of the global economy between China and everybody else. Because there are a lot of companies and governments that are uncomfortable trading with China and relying on China for imports and manufacturing. And that's becoming an issue. It already started to show up last year. It probably gets worse. So we're not looking at one thing. We're looking at a whole bunch of things coming together. This is, if I may try to show you this, this is our precious metals advisory, which came out yesterday. And we have this chart. I may have showed you this chart before. These are each bubble is something. The green bubbles are positive for gold. The red one is negative for gold. So we're looking at a world that's skewed to higher gold prices. Yeah. The bubbles are over to the right side, which means that they're right on top of us. They're bigger and they've also moved upward, which means that they're probably more important. So we're looking at a lot of problems hovering just over the horizon. And we think that some combination of those things is what contributes to a recession in that time period.
So you had mentioned the kind of war premium and also the inflation premium that is priced into gold at this time. Do those premiums also apply to silver the same way, in the
Absolutely.
same way?
Yes. Yeah.
So
although, you can argue, if you look at the gold silver prices right now, you can argue that the war premium is probably having a greater effect on gold than it is on silver.
When we think about the kind of the other, let's say, not as sexy, not as talked about, maybe metals in that group, is it possible that this, maybe more stable economic landscape is better for higher platinum group metal prices?
I think so, because, platinum group metal prices, we unpack them. We're bullish on platinum in the long term. Because we see, and we're kind of bearish on palladium, because there's a shift away from palladium intense catalysts toward platinum intense catalysts in the auto industry. And the auto industry represents like 40% of the platinum market and 67% of the palladium market. And palladium prices have risen over the last decade to record levels, and now they're on their way down. Platinum prices have been dead in the water for the last decade, and now they're starting to rise. So we think that there's a strategic pivot away from palladium toward platinum, which is probably going to last for a few years. And a stable economic environment would allow that to happen. We've already seen, our estimate is maybe 100 or 200,000 ounces of auto cat demand for PGMs shift from palladium to platinum over the last 3 years. But it's been masked. It's been masked by the pandemic, the lockdown, the sharp decline in auto purchases in 2020, and then the chip shortage and other supply chain constraints that have reduced auto production this year. So if we got to a more stable economic environment and political environment, you might see auto sales start to rise. We also think that there'll be a reevaluation of the speed at which electric vehicles can grow as a market. And people will realize that, the next 10 years, the next 30 years, the next 50 years, we are going to be burning petroleum in internal combustion engines. And that means we will need platinum, palladium, and rhodium to clean up the exhaust.
Yeah, so it's mainly the demand from let's say, the recovery of the production of new vehicles and the catalysts that have to go along with them, right?
Well, like looking at platinum, we say, well, why do you think platinum prices are going to rise? Well, we think that South African production is going to fall over the next 10 years. We think that automotive demand will rise a healthy rate. Other fabrication demand will probably rise. And at some point, we think that investors will return to platinum as significant buyers, as they were from, say, 2002 to 2007. Mm-hmm. They were big buyers of platinum, physical platinum. And then they kind of backed away from that. We think they come back at some point, but they need convincing. Right now, they're very hesitant to get into platinum. Mm-hmm. So we look at those combination of three things and saying, the platinum market's probably going to be a lot tighter going forward than people thought.
Mm-hmm. Jeff, I'd like to kind of, let's say, wrap up our discussion here with some of the, let's say, the news and possibly misconceptions around what's happening in Russia, like their financial actions. So maybe can we start by talking about some of their financial actions related to gold and what, let's say, the nuances in those actual stories would be?
Well, yeah. I'm not sure how much they've actually done in gold. They've talked about gold. Mm-hmm. And one of the things that's been wildly misconstrued was the Russian government about 2 weeks ago. The ruble collapsed with the start of war and the start of sanctions. The ruble collapsed to 1 cent per 1 cent per ruble. Mm-hmm. And the Russian government, the central bank, had most of its foreign exchange assets frozen. It has 74 million ounces of gold, but it's been struggling for cash. They basically said 2 weeks ago that they would pay 5,000 rubles per gram for gold from domestic miners and refiners. Mm-hmm. And they don't buy directly from the miners and refiners. They buy from commercial banks in Russia that buy from the miners and refiners. Mm-hmm. So they were saying, and the price at the time, given the ruble exchange rate, which was in the crapper, if I can use that term, the market price was 6,000 rubles per gram. Mm-hmm. And gold exports by banks, miners, refiners were pretty much prohibited. Platinum group metals weren't, but gold was. And so they were basically saying to the miners and refiners, we want to pay you a 16% discount to the market price for your gold. Now, when that was happening, they were also in the business of impoverishing Russian citizens. They had closed the banks, the ruble had collapsed, stores were closing, food prices were skyrocketing. There were shortages of all sorts of goods within Russia. They suspended the value-added tax because individual Russian consumers were suffering so much. And Russian consumers did what consumers anywhere in the world would do in that environment. They started buying gold. Mm-hmm. And they weren't paying 5,000 rubles or 6,000 rubles. They were paying above international market prices with a premium because they're buying small bars. Mm-hmm. And there's a very severe tightness for small bars in Russia right now. So the miners and the refiners were saying, why would we sell at a discount to the central bank when we can get a premium meet gold from individual consumers? So that's what was going on. Now, Russia did this whole thing. Then they turned to Europe and said, you have to pay for your oil and gas imports in rubles. And the Europeans said, no, we have contracts that say we pay.
Jeff, just before we continue on the Russian oil and gas thing, I think, again, the distinction that I kind of wanted to hit on there was that Russia was basically, they had said that they were going to pay 5,000 rubles per gram of gold. And a lot of people were kind of saying that presents an arbitrage opportunity if the ruble appreciates greatly, which it has rebounded quite dramatically, right? But again, that is for basically domestic supply inside Russia. So that kind of negates that idea that there is an arbitrage opportunity there, right?
Absolutely.
Okay.
Yeah, there was no arbitrage for non-Russian bank participants, Mm-hmm. But where I was going over with the oil and gas was what the ultimate resolution with Western Europe was: you can pay Gazprom Bank in euros, and they will immediately sell those euros for rubles. And the ruble has appreciated, not because anything macroeconomic. The ruble's appreciation in the last week has solely been a reflection of Gazprom Bank buying rubles to get rid of the euros that's been paid for oil and gas exports. So if you will, the recovery of the ruble is an artificial government artifice, and so that factors into the whole gold thing. So now the Russian government has said, okay, 5,000 rubles. Nobody was selling us at 5,000 rubles. So we're going to go back to what we used to do, which is we will buy at market related prices.
Mhm. Yeah, it's again worth kind of understanding those two situations a little bit more clearly. So the other part of this, I think I'd like to get your perspective on, is the idea that because of the SWIFT bans, that there are countries moving to get away from using the US dollar, and that could potentially mean the end of the US dollar as the reserve currency of the world. So do you see that move by other countries to be able to exchange, let's say, oil for something other than dollars as a real death nail or something like that at this point for the US dollar?
No, I think the only people who think that the SWIFT ban has anything negative to do about the dollar are people who have been predicting the dollar would collapse for decades. Mm-hmm. And anything that can come along to sort of substantiate their claims that the dollar is going to collapse. The SWIFT move has no negative connotations for the dollar. Now, there are central banks that want to reduce their dollar holdings. The average central bank holds 60% of its foreign exchange reserves in dollars. And that actually hasn't been falling sharply. It's been relatively stable, 59 to 62% of foreign exchange reserves held by central banks. Mm-hmm. And what you find is when central banks buy gold, by and large, some central banks are buying, like Turkey is buying from the domestic market, Uzbekistan buying from the domestic market. But those banks that buy in the international market, what they're doing is they're taking their current account inflow of dollars and using some of that to buy gold. Mm-hmm. So they're not actually reducing their capital stock of dollars, because the gold price would just go crazy if they tried to do that. Right. So, it's like this old adage that a Polish central banker told me in 1981, if you owe a bank enough, you own it. We were renegotiating a gold loan during the international debt crisis in 1981. And they said, we have more cards in our hand than the Western banks think, because if you owe a bank enough, you own it. And the United States owes the world enough that it owns it. A nasty thing for an American to say, but the reality is that the world is so flooded with dollars, and the liquidity of alternative currencies is so low compared to that of the dollars, that you're kind of locked into using the dollar for decades to come. But the SWIFT issue has nothing to do with the destruction of the dollar as the reserve currency, de facto reserve currency. Mm-hmm. And it only reflects the fact that you have these guys on the internet who have been wrong on the dollar for their entire careers. And anything that happens, Biden stumped his toe, that's got to be negative for the dollar. It's laughable, except for the fact that people listen to these guys. Mm-hmm. There's one guy, his first newsletter in 1981 said the treasury market's going to collapse. He still says that, and he has about 200,000 subscribers. Yeah. Like, at what point do you say, Father, I think I have to leave this church? This just isn't working here.
Mm-hmm. So, Jeff, when we think about how some countries like, let's say, Russia or China, supposedly have a lot more gold than they officially report to the IMF, what do you think is the reason for that?
Well, Russia, it's hard to say because it's always been state secrets, mm-hmm. And in some of our recent videos, we've talked about this, and we've expressed the opinion, which was built up at CPM Group by virtue of conversation we had with Soviet officials in the 1980s, 1990s, and Audits, Russia has a certain amount of monetary reserves that the central bank owns. There seems to be perhaps as much as 50 or 55 million ounces of gold that's held by the Russian army. And it holds that tightly. And it's looking at the destruction of its military right now and saying, we're going to have to rebuild this thing, regardless who's president of Russia. So there is that. And there are strategic stockpiles there. In China, you have different things. You have the central bank of China, and they report the gold that they have in their monetary reserves. There is a sovereign wealth fund called the China Investment Corp, and it at times holds physical gold and at times invests in gold in other methods. Then there is a thing called SAFE, which is an asset fund that the government runs, and it will hold a range of assets, including raw materials and industrial things. It's the same way that the United States has the National Defense, the Defense Logistics Agency has the National Defense Stockpile. And it doesn't hold gold, but it holds other assets like tin and tungsten and iridium that it might need, that the country might need. So there is stuff like that. I mean, we had one Middle Eastern central bank that a few years ago reported a large increase in its gold reserves. And people thought, oh, that country has been buying gold. But it wasn't. What it was it was a strategic amount of gold that was held by a different part of the royal family. And the royal family said, oh, let's add that to our monetary reserves. So you'll see stuff like that from time to time. Mm-hmm. The People's Bank of China stopped buying gold 2001 or so, but then they were in the process of creating the China Investment Corp. And so the government said, will you know how to buy gold because you were the national market maker and you held the reserves. You know how to trade gold. Please buy gold in the domestic market and put it in a special deposit, bucket, we call it, a side bucket. It's not going to be added to monetary reserves, but when the China Investment Corp when we flip the switch and it starts investing, we want it to have the gold you accumulate between now and whenever that is. And it actually was December of 2007 when they funded the CIC with $500 billion from the central bank. Mm-hmm. And that gold wasn't immediately transferred. And so you saw the CIC at the worst time in the economy since the Great Depression, say, okay, you have $500 billion to invest. Go ahead, find something worth investing in December 2007. Maybe American real estate, which was spiraling down for 12 months already. Mm-hmm. So the CIC was sort of sitting there like a deer in the headlights. That gold sat there. 2008 occurred. The U.S. Treasury screwed everyone except the banks in bailing them out, screwed the homeowners, screwed the economy, screwed foreign investors, screwed other central banks, to use a crude term there. And the Chinese government said, wow, that was really nice. Went to the People's Bank of China and said, put that gold in your monetary reserves. And say, well, we don't really want that gold in our monetary reserves. I say, yeah, but we need to send a message to the U.S. Treasury. There are alternatives to the dollar. Mm-hmm. Now, the reality was that they had almost $4 trillion in U.S. dollars. They probably had about more than $3 trillion in U.S. dollars. And the gold was like 0.1% of its assets. So, but it was something.
Mm-hmm. So, when we're specifically talking about, let's say, China and that sovereign wealth fund, do they have to report their gold holdings as part of China's official holdings, or is that kind of a vehicle to make it separate?
It is a completely different vehicle. Mm-hmm. It actually is, I guess, managed by the central bank. Mm-hmm. But, sovereign wealth funds are not monetary authorities, and they are not required to report their assets to any organization like the IMF, which collects data from monetary authorities, obviously they have to report to their masters, which are their government. But that's true around the world. So, Norway has the largest sovereign wealth fund. GCC countries have enormous sovereign wealth funds, and they don't necessarily report what they've got in there.
Jeff, something that you and I have touched on before, and I don't think we need to spend too much time on it, but, it's always brought up that the gold reserves at the Fed need to be audited, or sorry, the Treasury, right? The gold,
right.
The US gold is held by the Treasury. And you've told me before that the reason it hasn't been audited, let's say every year, is because there are no real movements in or out. So can you give us the picture as you understand it of, let's say, the auditing point of the US Treasury's gold holdings?
There is a paper audit every year. And again, you can go to ustresh.gov and you can download the KPMG audit of the gold. Most of the gold, virtually all of the gold that the US Treasury owns is in sealed vaults. Mm-hmm. So the bars are there. Okay, so let's first talk about audits. There's a paper audit every year. Sealed vaults, KPMG goes, the seal has not been broken. There's my signature from last year. Mm-hmm. I don't have to worry that this thing has been tampered with. Mm-hmm. There was what they called a deep audit. I believe it was run from the from the 90s into the Audits. 261 million ounces of gold. That's about, if my math is correct, about 250,000 bars. And they looked at every bar and they checked it off compared to the list of the bar list that they had. Okay, this is the bar. Let's weigh it. Okay, we weigh it. It's got the right serial number. It's got the right weight. We check it off. And then they took a representative sample of those however many bars and said, let's take little drill cores and send them and have them assay. And this took, I think, 8 years. It took a long time to do because you have to unseal the vault. Once you get inside the sealed vault, there are drums in many cases with the bars in them, and the drums are sealed with signatures on the seals. So then you have to open it up, and then you have to take the bars out, and you have to measure it, find the bar on the list, blah, blah, blah. It takes a long time. Mm-hmm. So there have been audits. And, when Ron Paul had his hearings at the end of his career, he had hearings on this, and the Treasury said, here is the deep audit. Here's the audit where we check the weight and serial number of every bar. Mm-hmm. And he said, and it used to be on YouTube, his hearings, he said, why didn't you tell me this? Because I've spent my entire career telling people that the gold should be audited. Why didn't you tell me that you were auditing it? And the Treasury said, well, you never asked. I mean, you went on public venues and you spoke poorly of us and acted like we were complete buffoons, but you never asked us if we had an audit. If you had asked us, we would have told you. And in fact, you can go to treasury.gov and get the annual audits, and you can go to treasury.gov and read about the deep audit because it was all public information. Mm-hmm. Ron, you just wasted your life. And you buffaloed all these people into thinking there was something nefarious about the Treasury. And they believe it because, hell, you're an obstetrician. Obstetricians don't lie about gold, right? So the audits are there. And the gold is, as I said, it's sealed in vaults, sealed in many cases in drums. Other times the bars are stacked. And it's there. And it's been audited. And they check all the time to make sure that those vaults have not been opened. And I can't tell you stories about wanting to see inside the vaults, but you just can't. Now, there is a little bit of gold outside the sealed vaults in other vaults. And that is there in case it's ever needed. And the Treasury lends some of that gold to the US Mint, which is part of the Treasury, to use as working inventories for the coin manufacturing. Mm-hmm. And the deal is this: as long as the gold is in the Treasury's possession or in the possession of blank manufacturers, that gold is on loan to the mint. As soon as you sell those coins, you replace that gold. And the mint goes to the level of saying, okay, we sold 4,000 ounces of gold, eagles and buffaloes yesterday. We're going to buy 4,000 ounces of gold in the London market. We're going to have it air freighted from London to Newark and then driven up the Palisades Parkway to West Point with a Brinks truck. Mm-hmm. And that's a very expensive proposition. In the 90s, we were working with the mint on ways to make the gold coins program profitable because they lost money every coin they sold. Mm-hmm. And one of the things we said is you can save a tremendous amount of money. Pool your gold in London. Leave it at the Bank of England. And when you have 16,000 ounces, half a ton, you can ship it. And what you're doing is you're reducing the per unit cost of shipping that gold. And that shaves several dollars off the cost of manufacturing and selling those coins. Mm-hmm. And that would help you. Furthermore, leave it at the Bank of England until you need blanks manufactured, and then ship it directly to the blank manufacturers, and you save even more transportation costs. Mm-hmm. Just a little way of reducing the losses per coin. And the Treasury said no. Treasury said no. And we said, why not? And they said, no, this gold has to be in the possession of the US Mint / Treasury all the time. So we're not going to pool gold in London. And I said, well, you pool billions of dollars and other assets in banks around the world. And they said, yeah, but that's money. This is gold. I said, what do you mean? He said, it's gold. And we treat gold completely differently than we treat currencies. Furthermore, we have these crazies like Ron Paul running around with all these stupid conspiracy theories. And the last thing we need is for them to say, oh, I've got proof of a conspiracy that the gold isn't really held by the Treasury. It's at the Bank of England. Yeah. So the Treasury actually for decades has gone out of its way to hold every ounce of gold that it has, in part because it doesn't want to get give any ammunition to the people who are going to distort reality and try to scare people into buying gold.
So is there any way to tell if that gold is actually like encumbered or leased out in any way as well, Jeff?
Well, that's a different issue. And we've gone through it and we actually provided all kinds of information. The Treasury says it's not. Mm-hmm. It doesn't show up as being encumbered in any Treasury statement. And, these are guys who they measure how many pencils they've got. And you can actually look at the data if you want to. I know guys out in Idaho, who have asked us about this, and we've told them where they can go in the Treasury to find out all this information, and they don't want to know it, mm-hmm. Because they're sitting around scratching themselves saying, no, there's a conspiracy, it's hidden. Mm-hmm. But there's absolutely no indication that it's been hypothecated, and there's been no reason for it to be hypothecated. And there are no shadows in the market. Mm-hmm.
Jeff wanted to add a little bit to his answer about the rehypothecation of gold. So he sent me a bit more of an email explaining and going a little bit more in depth on what he was thinking about. So he said, I thought of my response to your question as to whether the Treasury's gold has been secretly hypothecated and realized that I should have been more succinct. Perhaps you can add the following response to your comments before or after the interview. Let's consider the allegations as a court of law would. There is no evidence that the gold has been hypothecated. There is no rationale for the Treasury to have hypothecated it. The value of the gold is a fraction of one quarter of the Treasury's debt and the value of the US government's total assets. Hypothecating it would have no substantive value to the Treasury. So then you consider the nature and the source of the allegations. The allegations lack substance and change over time. They are vague as to when and whom the metal may have been hypothecated, as well as the nature of the transaction. The allegations range in time from some undetermined time in the past to the 1990s and other years. The allegations have been put forth by people who promoted allegations that the gold was physically gone, fantasies that have been disproven, having been shown to be fantasizing about a physical sale. They have changed their fantasy to one of a financial transaction. A court of law would throw out any such allegations for a lack of substance and evidence. Well, Jeff, I think that's a reasonable place to kind of wrap up today's discussion. We went into a lot of depth here, a lot like your, how many 100-page gold yearbook is it this year?
It's 250 pages this year. So it's a 250-page report. It's not as scary as it sounds because a lot of the 250 pages are charts and tables. There is text, and but there's a lot of charts and tables. This is gold reserves, mineable gold reserves. It's a tremendous font of information for somebody who actually really wants to know about the gold market.
Yeah.
Or as one gold conspiracy guy said after he debated me, I hate debating Jeff Christian because he clouds the discussion with a bunch of facts.
Well, I want to thank you for sharing some of maybe a small portion of those facts with us today, Jeff. And of course, that gold yearbook is available on your website, cpmgroup.com, right?
Right. It's downloadable as an ebook.
Perfect.
Yeah. And the
Jeff,
last page says if you want a printed copy like this, you can go to a copy shop with the PDF and here are the print specs.
Yeah, absolutely. Jeff, I want to thank you so much for your time and your perspective today.
Well, thanks for giving me a platform. Thank you.
Absolutely. Thanks, Jeff. Take care.
Bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.